All right, today we're doing a forensic deep dive into one of the most popular and honestly riskiest tax strategies out there for families with college students. It's often called the Emancipated Student Gambit. Now, it promises thousands in tax credits, but as we're about to see, it can unravel under the slightest bit of scrutiny from the IRS. So, let's get into the analysis. And this is the big question, right? It's the siren song that lures so many people into this strategy. You see, parental income phase-outs often make the American Opportunity Tax Credit, the AOTC, totally inaccessible. So the idea of having the student just file on their own to claim that full $2,500 seems like a brilliant workaround. But can they actually do it? Well, the answer is a whole lot more complicated than a simple yes or no.
So here's our game plan. First, we'll break down the strategy itself. Then, we're going to methodically dismantle it by looking at the hard facts of dependency rules, a critical flaw in the AOCT law, the nasty surprise of the Kiddie Tax, the really severe audit penalties, and finally, the devastating collision this whole thing creates with federal financial aid.
Okay, so what exactly is this gambit? Conceptually, it's pretty simple. The parent's income is just too high to qualify for the AOTC, so they make a choice. They decide not to claim their college student as a dependent. The student then turns around, files their own tax return, claims themselves, and grabs the full $2,500 AOTC, completely sidestepping the parental income limits. I mean, on the surface, it sounds perfectly logical, right? But this logic, well, it's built on a house of cards.
And that brings us to the first pillar we're going to knock down, and honestly, it's the most important one: dependency status. You see, under Internal Revenue Code Section 152, dependency is not a choice. It's not a box you can just check or uncheck to get a better tax outcome. It is a state of fact, and it's determined by a series of very rigid, very specific tests written into the law.
So for your typical undergraduate student, these are the 5 tests under IRC Section 152 that decide if they are a qualifying child. Now, the first 2, the relationship and age tests, they're usually pretty straightforward. But the strategy really starts to fall apart on the residency and support tests. The IRS is crystal clear that living in a dorm is just a temporary absence, which means the student is still legally considered to be living at their parents' home. So the whole battle, nearly every single time, boils down to one thing: the support test. Did the student really provide more than half of their own support?
And this is the statutory checkmate. The law doesn't ask if the student was claimed, it asks if the student can be claimed. And if a student meets all 5 of those tests to be a qualifying child, they are legally blocked from claiming the AOTC themselves. The parent can decide to give up the dependency exemption, sure, but they cannot legally just transfer the student's eligibility for the tax credit. The status is locked in by the facts of the situation, period.
So, how does the IRS even figure out support? Well, they look at where the money came from. Any money the student earns or saves, that's their support. Student loans in their own name also counts as support provided by the student because, hey, they're the one on the hook for the debt. But Parent Plus loans? Nope, that's parental support. And money from a parent-owned 529 plan? That's also parental support. These aren't just suggestions. These are the hard lines that decide things in an audit.
Now, this is a super critical piece of the code that so many people miss. IRC Section 152 F5 says, point blank, that scholarships are completely ignored in the support calculation. You just pull them out of the equation entirely from the student's side and from the total support amount. This is a perfect example of how the law actually makes it harder for a student to prove they're independent. Think about it. If a student has $50,000 in total costs and $30,000 of that is paid by scholarships, poof, that $30,000 vanishes. The test is now based on the remaining $20,000 of living expenses, and the student still has to prove they paid for over $10,000 of that with their own money. That's a much, much higher bar to clear.
But let's just say, for the sake of argument, a student somehow navigates the support test. Maybe they took out a bunch of student loans. They file as independent. They're still not in the clear, not even close. You see, Congress built a poison pill right into the law specifically to stop non-working students from getting cash back from the government. And you can find it in IRC Section 25A I-6.
And to really get this poison pill, you have to understand the sharp legal line between support and earned income. They are not the same thing. For that dependency test we just talked about, support is a really broad category. It even includes loans. But for the refundable part of the AOTC, the law uses a much narrower term, earned income. This means W-2 wages, tips, self-employment income, that's it. It specifically excludes loans, scholarships, gifts, and investment income.
And here is the test itself, straight from the code.
A student gets disqualified from that $1,000 refundable piece of the credit if all four of these things are true. 1. They're a full-time student, 19 to 23. 2. They have at least one living parent. 3. They're not filing a joint return. And 4, this is the big one, their earned income, remember that's wages, is less than half of their total support. So a student who's only independent because they took out $40,000 in loans but only made $5,000 from a summer job, they fail this test. End of story. The loans count for support, but they are not earned income.
So here's the bottom line. For a student who gets knocked out of the refundable portion, they can only get the $1,500 non-refundable part of the credit. But a student with little to no earned income also has little to no tax to pay, thanks to the standard deduction. And a non-refundable credit can only reduce the tax you actually owe. If you owe zero tax, that credit is worth, well, zero. So after all this work, all this risk, the net financial benefit for the student is, in a whole lot of cases, a grand total of nothing.
Okay, now let's look at a slightly more clever version of this strategy. Sometimes, to create enough qualified expenses for the AOTC, a student might choose to treat part of a tax-free scholarship as taxable income. But this little move can walk them straight into an even bigger problem, the Kiddie Tax, which gets reported on Form 8615.
And here is the totally counterintuitive part. For the Kiddie Tax rules, the IRS classifies that taxable scholarship money, the part for room and board, as unearned income. It's treated exactly the same way as interest, dividends, or capital gains. It's not treated like wages at all.
And that is the trap. If that taxable scholarship income goes over the annual limit, which is really low, around $2,700, the extra amount isn't taxed at the student's low rate. Instead, Form 8615 forces it to be taxed at their parents' highest marginal tax rate. This can completely wipe out any benefit from the AOTC. And what's worse, to file Form 8615, you have to put the parent's social security numbers and their income right there on the student's return. That creates a direct data link that just torpedoes the whole "I'm independent" story.
Okay, so far we've just talked about why this strategy doesn't work based on the law. Now, let's look at the real-world consequences when the IRS computers, which they inevitably will, flag these tax returns.
The most common way this whole thing gets flagged is super simple. The student's social security number pops up on two different tax returns, the parents' and their own. The IRS's computer system, the automated underreporter, flags this instantly. It doesn't send a refund. It sends out a letter, notice CP87A, to both the parents and the student. It's basically a dueling dependence letter, and if nobody backs down and fixes it, a correspondence audit kicks off and the entire burden of proof is on the student to prove with a paper trail that they were truly independent.
Now, if the IRS says no to the credit, the fallout is way more than just paying back the money with interest. If they decide the claim was made with reckless disregard of the rules, which is a pretty low bar we'll define in a second, that student is banned from claiming the AOTC for 2 full years, even if they're totally legitimately eligible in those future years. And if the IRS finds evidence of actual fraud, meaning an intent to deceive, that ban skyrockets to 10 years. A 10-year ban could basically wipe out any chance of getting education tax credits for their entire academic career.
So what's the difference? Reckless disregard is basically failing to do your homework, like not bothering to do a support calculation or just ignoring the earned income rule. The IRS sees that as being willfully blind to the rules. Fraud, on the other hand, is actively making things up, faking a lease, creating bogus income records, or trying to hide money from parents. The penalties are designed to be harsh for a reason, to stop people from trying this stuff.
And now for the final and maybe the most damaging consequence of this whole strategy. This isn't just about the IRS anymore. This Emancipated Student plan creates a direct, unavoidable conflict with the Department of Education's rules for federal financial aid. This table just perfectly illustrates the problem. The IRS and the FAFSA have completely different definitions of independent. For the IRS, yeah, a 21-year-old can be independent if they pass that support test. But for FAFSA, a 21-year-old undergrad is almost always considered a dependent student. They have to provide parental financial info unless they meet some very specific criteria, like being married, a veteran, or a graduate student.
And here's where it all blows up. The new FAFSA system uses what's called the Direct Data Exchange, the DDX, which automatically pipes your tax info from the IRS straight to the Department of Education. So when a student claims dependent on their FAFSA, but the DDX pulls a tax return showing they filed as independent, it triggers a massive conflicting information flag. The college's financial aid office is then legally required to freeze all federal aid, Pell Grants, subsidized loans, all of it, until this discrepancy is fixed. And that almost always means having to amend the tax return. The student gets trapped in a compliance pincer that they built themselves.
So we have to end with this question. After we've picked apart all the rules, from the factual nature of dependency to the AOTC's poison pill, the kiddie tax trap, the severe audit penalties, and the huge financial aid collision, you really have to ask yourself, is chasing a tax credit that's often worth zero really worth the profound risk of an IRS audit and the very real chance of losing thousands of dollars in financial aid? The forensic evidence strongly suggests it's a gamble that almost never pays off.